Hey guys, this is Israel. Israel Keys Academy, Israel Keys Wealth Academy. You know what we are, you know what I am. Let's get into it. So I just did a quick review on a trade yesterday, showing some of the principles that we taught this past week and how they're already being applied in productive ways. So we're in the middle of the at the end of the mentorship sessions on market conditions. We've looked at the three market conditions. Well, the fact that there are three: consolidation, reversal, and trending. The fact that you need to understand the context of a market condition before you take a trade, because each condition has different rules through which you apply the same principles. So like the tool bag of a handyman, every job calls for a different tool. You don't just apply strategies or systems willy-nilly, as many cowboy, and I keep using the phrase cowboy trading instructors have taught some of you to do, and hence damage your experience in the markets. And we showed how you can frame trade ideas using the other two. Now we want to focus on the final market condition, which is the trending condition. So to do this for this one, I try to use a different currency pair with every single one. To do this for this one, I'm going to use the GBUSD. Now, I usually I've kind of stayed away from it in recent weeks because of all that's going on with Brexit and stuff of that nature. Sometimes it's difficult to distinguish between what is just normal price action and what's the the effect of the fundamentals in Brexit. So, but let's work with this because it actually fits quite well in this particular context. Whether or not it's fundamental doesn't change anything. So, trending. Now, what's a trend? The phrase trending is perhaps the most ubiquitous, commonly used in Forex. We've heard phrases like, the trend is your friend until it bends or it ends. We've all been told to make sure we trade with the trend, and for good reason too. But first of all, how do you establish you're in a trend? That's the first key, because many times by the time you figure out you're in a trend, the trend is at an end. And what's so powerful about trends? Now, this is how many of you have been taught to understand trends. Again, you guys know how much I hate trend lines. They're called trend lines for a reason. I hate them because price or the market does not respect. This is weekly, so I'm going to change it to my color red, danger red for weekly. Price doesn't respect horizontal lines. Market makers, the price algorithm, there's nothing sensible about a horizontal line in terms of understanding what we've taught you guys drives the market. All there are spatial delineations of how people's mind works. But the problem is they don't take into account the underlying factors. They're just showing you what's happening. So a trend line is what you call a lagging indicator. That's why I don't like it. It shows you what's already happened. It doesn't tell you what's going to happen. For instance, this is a trend line. Why? Because price has touched it 1, 2, they say 3 times. So 3 touches and it's a trend, and then you expect it to move in that direction until it breaks the trend. And so you will be told that at this point at which it breaks the trend, this is the point at which it breaks the trend, right? No, that's not the point at which it broke the trend. That's the point at which it broke your trend line. There's a difference. This is the point. I showed you this with reversals. This is the point at which it breaks the trend. Market structure, watch the previous video, is bullish. There is a break in market structure, bearish. At this point here, and like I said to you, there is going to usually be, at some point or the other, usually there needs to be a substantiation of the broken structure. In essence, it's from the higher low or lower low there. We want to see a lower high form. So that would be here. So at this point here, but as you can see, it did not retest your trend line. because it didn't respect your trend line. Your trend line had nothing to do with it. Why did it stop here and then here in this region? Very simple. Because in the past, there is a previous area of liquidity there. You see that there? That one right there. That high here is what you call a pivot point. So this is actually the test here. This is actually, sorry, that's it there, not there. That's the first low formed at that point. And that's how and then of course it retests it again here. It dips back into the liquidity pool here. And then it keeps going down. So this is not needed. You see, it's a lot cleaner when you look at it this way. Because the problem with using, some people argue and say, well, what's wrong with using both? Just using the trend line to help you see what's going on first, then looking for the actual price action principle, because your brain is designed to work in patterns. And so if you start putting trend lines on your chart, you start seeing them everywhere. And in places where there is no trend line, for instance, let me give you an example. This would be an example, a classic example of where a trend line would fail you. See that there? So it breaks the trend line, doesn't it? Right? But then what happens? Price falls out of bed. So this trend line here would have lost you money. Why? Simple. On the larger period, that's the last low there. What looks like an upward trend line break here is simply price breaking market structure on a larger pattern. Look at that there. This is what horizontal lines do for you. And so it breaks the structure there. It comes back up, finds a lower high, breaks through it again, tests it one more time, and falls out of bed. The horizontal line is what drove price, not the phony vertical one. Does that make sense? Not the phony vertical one. So anyway, enough of my rant. So trends. There is no standard definition for a trend. That's just the truth. But all it is a discernible, consistent movement of price in a pair in one direction. Simple. That's anybody who tries to define it any other way using EMAs or their rules of thumb. When this EMA crosses over that EMA, again, we don't trade with EMAs here at Israel Keys Wealth Academy. When the trend line, we don't, just make it simple. A trend is what happens when over a significant period of time, price moves discernibly in one direction with repeating market structure. Now, how long is that time? Again, depends on the time frame you're trading. You can see that this weekly trend took over a year. Price was trending upwards from this point to that point. So that's a whole year in the middle on the weekly. That's a quarter. So 18 months period, pretty much. From September to March, price was trending. If you drop down to a daily time frame, there are several daily trends in that period. Look, so that's a time frame from September. So technically, that's a trend, and that's a trend, and that's a trend. At least on the, well, okay, technically, you could argue that on the daily. Okay, fine, I'll give you that. On the daily time frame, it is pretty much an upward trend all the way, daily. But if you drop down to a 4-hour time frame, then you can see what I'm talking about. So on the 4-hour time frame, and this is why we actually ask you to drop 2 hours, 2 time frames or more when you trade, because the time frames that are right beside each other usually tend to say pretty much the same thing. One is just more refined than the other. So anyway, so in the 4-hour time frame, this is a downward trend, consolidation, then an upward trend, then a downward trend, then an upward trend, then a consolidation, a down. So you can see that the concept of the trend is again time frame related. And if you dropped even further down to a 15-minute chart, it would look even more crazy in terms of, let's see if you can find that in a 15-minute chart, even more crazy in terms of the fact that there are multiple trends involved there. I think we've passed it. Or have I gone to another year? I think I've gone to another year. You know what? I'm not going to bother trying to find this. You get the point. You understand. I'm sure you understand the principle of what I'm trying to say. So let's go back up. There we go. So if we agree that a trend is price moving in a discernible direction, meaning it's not reversing at this point, it's moving. There may be mini reversals. We're going to come to that in a second, but it's moving primarily in one direction with repeating market structure. So let's drop down to a daily to look at this trend to give it more clarity. Now, like I said, the lazy way is to try and draw a trend line. That's the lazy way. Well, that's your first trend line. And some of you charts look crazy because they teach you draw the first trend line and the first touch, then draw the second trend line at the second touch. Well, that would have broken the trend line there, wouldn't it? See, immediately you have a trend line break. And then they tell you when it breaks trend line here, it should come down to the other one. Did it come down? No. So just do away with this nonsense, right? It's baloney. It's rubbish. It's not how trading works. It's, yeah, your market breaker. You don't need that. So I'm going to change this color to a lighter color just so that we still see what we're working with, but it's a lot more. Okay, so that's actually, you know what? I am going to take that away. I'm just going to put in horizontal lines to delineate the period of time we're working with. So that period to that period, and then that can go. Okay, that looks ugly. Right. So this is our trend period. Now, remember we said market moves start with consolidation, right? Cool. So we're looking for consolidation. That's the period. From there to there. There we go. So on a weekly chart, would you agree with me that on a weekly chart, I got to get rid of this ugly color against the white, it just hurts my eyes. Yeah, so on a weekly chart, would you agree with me that that is a weekly consolidation? Yeah, it is. Now on a daily chart, not so much, but on a weekly chart, that's a weekly consolidation. This is the weekly reversal when the trend ends. This part here is the reversal when the trend ends. Actually, sorry, I meant this is a weekly reversal. Sorry, weekly reversal. That's one reversal. That's another reversal. Although, like I said, sometimes reversals start out as consolidations, but then they tip their hand as reversals. And this is a consolidation here. So you see that even on a weekly chart, there we go. So there's a consolidation, there's a manipulation, a reversal, an expansion, a retracement, and then a follow through the target. So that's a consolidation. This is a reversal profile there. That's the opposite reversal profile up there. In which case, this here is the real trend. The trend starts when the reversal is complete. Yes, I'm going to take that away. And it carries on until the next reversal starts. What did I do there? Get rid of that. So this is the actual trending period. Consolidation, manipulation, reversal, trend, reversal / consolidation, trend the other way. So this is the period we're looking at. And again, I am just going to draw this line. Actually, let me put this one here just to tell us that this is the period that we are analyzing the trend. I'm sorry if I didn't give you a fancy definition of a trend. There is none to give you. You just have to look at it. But I can show you what drives it, which I'm about to do in a second. So let's drop back down to the daily. Right, so we're looking for that period. And here we have it. So this is a trending period. Again, like I said, if you're lazy and you drew a trend line, well, okay, fine, cool. But then don't do that, please. Just don't do that. Learn to trade. So this is the trend. What makes it a trend? Well, first of all, we have a consolidation here. We have a manipulation, another consolidation, then a reversal. Remember what we spoke about? Reversals happen when there's a break in market structure. That here is your market structure break. This is the daily chart. So green. I'm going to take the dividers off. There we go. So now there's an argument to be made that market structure broke here, first of all, and that would be true. But like I said, this is a consolidation at the beginning. In fact, let me make this clear. So this is the consolidation here, right? That's a consolidation there. Price breaks out of it, but that's a consolidation. And so how do you know which market structure break to go for? Well, let me give you a couple of rules of thumb. So this happened there, and then it broke structure there. Okay, that's fine. It broke structure there. You expect it to come back and test the structure. But as you can see, it refuses to stay above that level. It doesn't show any willingness to stay up, even when it gets back there. And so until price, you want to see an explosion. And also it doesn't confirm the structure anyway, because it forms a lower low here. But when you draw your market structure break levels, you want to see high velocity moves through them. That shows you that there's institutional sponsorship. Someone with deep pockets is driving that move. If it's just dipping in and falling back out of bed, it's telling you it's still consolidating. In essence, they're still picking orders. And where are they picking the orders at? Around the average price of the consolidation. So if you draw a halfway line there, you will see that acts as what I call a real pivot or pivot. That's the real pivot, not the ones you calculate. You see, the price is spending half as much time above as beneath. It's balanced around that level. And so you're going to be watching that level for high velocity market structure breaks. And what do you know? This is the first high velocity market structure break. No, what are you doing? There is the first high velocity market structure break. Why do I say so? Look at this. When price breaks above that, you can see on the daily, it closes above it and pushes up. Let me show you how many pips that is. I know it looks, but on a daily chart, that's 285 pips. So that's velocity. As opposed to this one here, that was less than 100 pips. And as you see, after the first day, it didn't really push up past that first day. The second day stayed at the same level, and the third day came back down. But here it goes up. Okay, second day comes back down, then it pushes up again. So at this point, it comes down and it forms a swing low here beneath the level as you expect, but it's a higher low. So it's come back down, it's a higher low. Now, I teach you guys, like I showed you on the trade I did earlier this week, wait for that initial one to be violated half the time, because the market makers need to manipulate liquidity. And so don't run there, especially if it's too near the line. See, it comes back down and it really dips into it very, very well. Also, if you look, there is a daily liquidity profile, an order block in there, right there. And so that happens, and then it explodes again above this, hangs around there. You're still not sure you're in a trend here. What I'm trying to make is, in this entire period here, this is a reversal profile. From this point onwards, from the point at which it breaks market structure here, this is the reversal profile we spoke about. So this is the consolidation profile. This is the reversal profile we spoke about in our last session. Yeah, that trade is starting to move nicely now. It becomes a trend when it forms its first market structure high or low that confirms the new direction. So this, for me, you could argue it, you may be right. I'm just telling you what has worked for me. Been trading 12 years, been very profitable for the last 5. I've shown you guys for the last year in my mentorship and trading training groups that I'm not just all talk. I put up, or I shut up. Trend starts here. Whatever anybody else tells you, that's fine. If they're your mentor, good. For me, my students, this is where the trend starts, because this is where the reversal profile is complete. At this point here, this confirmed shift in market structure tells us, especially on something as high as a daily chart, that there's a new direction. There's a new direction that we should be following. And so we go. As the millennials say, we move. Now, with a trend, you expect market structure to follow a pattern, which is higher low. If it's an upward trend, higher highs and higher lows. If it's a lower trend, lower lows and lower highs. And so you're watching market structure. So trend starts there. What am I watching? You want to see confirmed market structure breaks in the direction of the trend. So there is a market structure break here. That's the high. Price breaks through it, comes back down. It sweeps that low. Then you're going to see this a lot, where in a trend, there is an intermediate liquidity run. So anybody who had a stop loss below there is going to be taken out. So anybody who's a breakout trader who doesn't understand market structure is going to be taken out there. And that's how the move is kept going. Because to keep a move going in one direction for long periods of time, they need to keep engineering liquidity. And so the let's see if I can get this to work. The liquidity is engineered by this short-term liquidity runs. You know what? That's not wanting to, so just keep it out there. This short-term liquidity runs. So they take out the liquidity here. But notice they respect the low that was formed from the high that engineered the market structure break. So from this high here, all these are intermediate lows. The low that drives the break of the market structure, the original one down here, which was also liquidity run on this one. I hope you guys can really see this, because this is how trading works. So that low there is a significant market structure low, because it took out liquidity there, it drove the break, and price respects it. So the trend is still intact, right? And then the trend is still intact. And then there is another market structure break there. There we go. So that's now the new remember, that's the new reference low. This is no longer the reference low. If this low gets taken out, start getting worried about your trend. This is now the new low, because that's the last time they dipped into a intermediate liquidity pocket. It breaks market structure through there. It drives back down. It takes out that one there. You might not realize, but that's actually a low, a valid swing low. And it respects it. It doesn't come back here. So this now, and then this is tested, and this holds. At that point, this is now the new reference low here. If that low gets taken out moving forwards, you worry about the trend. And then you move again to the next market structure break. Because remember, like I said, there's going to be, this is a good place to point this out here. So the two sub conditions of a trending condition are expansions and retracements. We looked at this before, right? So in the trend, the expansion is the move in the direction of the trend. That's an expansion. The retracement is the counterbalance move to come back and pick up liquidity. And a sign that the trend is still valid is you want to see the retracements being shorter than the expansions. So that's 877 pips. The retracement is 650 pips of 30 something pips. That's not big on a daily time frame. If this starts to become, and you're going based on the reference highs and lows in the trend, you need to understand what are the intermediate highs and lows and what are the reference highs and lows. And I've just showed you, these are the ones that take out liquidity significantly and then drive back down for the liquidity. And you really, in an upward trend, it's the reference lows you should be worried about. In a downward trend, it's the reference highs you should be worried about. Because in a downward trend, if you take out a high, a reference high, it's a sign the trend is reversing. In an upward trend, if you take out a reference low, again, it's a sign that the trend is reversing. So this is the new market structure break there, right? Remember, this is now our new reference low. Price drives above it, comes back down, doesn't dip into it, which is fine, and then drives again. So in essence, we formed a high, that high there respected that. So that low there, sorry, respected this low here. So at this point, you don't know you're in a reversal. Let me take that box away. We now know this was a reversal in hindsight. But as at that time, if you were in the market on this day, at this point, when you see that low form, and again, it's beautiful because it took out an intermediate low here, right? So all you know is this low here is your new reference low. That's all. The trend could have gone on for another year. Some trends go on for 3-4 years on a daily or weekly chart. This is when you know there's a problem. See that red line I drew there on the weekly? That was the weekly market structure break. I'm going to take it away on the weekly. So that was the weekly market structure break there. Take it away on the weekly. Let's go back down to a daily. Let me show you the same thing on the daily. Remember I said that this now here, as at this point where that low respects that low down there, and it drives price up again. And look, this was a valid market structure break. This could have gone on going high, but look at what happens here. That new reference low is violated there. Boom. And so you had a market structure break, but it wasn't substantiated with a higher low. It took out the reference low. And it took out that reference low, and it took out this other intermediate low here. At this point, this is how the transitions work. At this point in time, you now know in retrospect. Sorry, I should actually draw that as an, so let me throw that away. So at this point in time, when this happens here, this blows out here, right? And forms a low there. You now know that in hindsight, this was a reversal profile. And you stop applying the rules of the trend, and you now apply the rules of a reversal. And what are the rules of a reversal? Before the next trend, price can go straight from the reversal to a new trend, as it does here, in which case inside the reversal profile is a mini consolidation first. See, and that there is a consolidation because price is refusing to really go above that point. And then here, so in essence, you treat this. Okay, good point. I just got inspired about something. In the middle of a trend, you will see several mini consolidations. That's fine. Price is just, again, trying to capture liquidity to move further. So inside the trend, there will be several mini consolidations. That's okay, as long as all the consolidations keep breaking out in the direction of the original trend. This is an example where this consolidation here drove a reversal. Trend over, meaning in this point here, you deal with a reversal scenario, moving out, and then a new trend starts to begin. So that's good in terms of identifying the trend. So I know what you're saying. Well, show us, like you did in the other two videos, how you can use this to get a trade. I'm glad you asked. Let's open up a brand new GU chart here. Let's go back to the time period in question. So let's see. This was 2017. Okay. Let's go back to the daily chart. 2017. Yeah, there we are. I believe, yeah. So this is the trend period we were working with. Like we said, so the market structure break happened there. It was confirmed. So this is the point at which we believed that we were now in a trend, I believe. And this was the point, or the trend was confirmed, I should say. 1 second, there's a line I put there that I shouldn't have put. Okay, get rid of this one. So that's the beginning, and this was what we accepted as, I believe, the end of said trend in retrospect. So let's take the dividers off. How do you frame the idea? Simple. You've got pretty much 1 year to work with on the daily chart. For 1 year on the daily chart, you knew you were in a trend. The simple way to go about it, first of all, is Fibonacci's. You go from high to low, and you wait for 61.8 retracement. Remember, in the trend, you believe that, actually, let's go back to the other chart because I want to show you the reference, because yeah, I think I need this because we need to work off the reference lows. So you believe in the trend that so this is the first reference low here of the trend. So this is the reversal low. This is the first, and then these are the lows. So this is the original reversal low here, which is also the reference low till the next one forms. I'm going to take away these boxes so we have more spatial cleanliness, because I really need you to get this. This is how you make your money. And when you make money, I'm happy, because then you know what we're teaching you works, and you continue to subscribe, and you make money, we make money, we're all happy. Isn't that symbiotic? It has a nice Hakuna Matata symmetry to it. Your happiness is my happiness. There we go. For both selfish and selfless reasons. So once from the market structure breaks, you are drawing Fibonacci's. This is the easy way to do it. I'm going to show you a more refined way that gives you more skill to apply. But if all you understand is Fibonacci's, very simple. You've identified a trend. Okay, fine. There we go. High to low. Reference low is formed where? Okay, roughly between 78.6. You actually wait for the low to form first. You don't just assume. So that would have been the first time it formed there, and then it would have come back and dipped a bit more. If you put your entry in here, the stop loss on the daily chart would have been 158 pips. On a daily chart, that's very, very, very good. If you're a swing trader, you have a couple of options. First of all, you wait for it to get back to the original high. That's already 3-1. Look at that there. That's already 3-1. But you are waiting. If you're in a trend, you expect it to go higher. And so you then have, there's two levels that I like to look at. There's the 121% level and the 161.8 level, either of the two of them, because that's above. That's where you expect the new high to form. So this first high formed where? You can see this already on my fib tool. So that's target 1, target 2. You come out, you're waiting for the next retracement. So from there to there to there is one leg. At that point, this becomes the new it becomes the new reference low. So you do away with that one. You throw your fib in again down there. That now becomes a new high. No, this one here now becomes a new high. Does that get to 61.8? No, it happens. Why? Because you can already see there's an intermediate one formed there. So when you see that reversal, just check. Was there an intermediate high that the fib is respecting? Yes, there was. That then gives you a perfect 61.8 halfway between 61.8 and 78.6. And so you could then trust that move there the day after it formed. So you'd get in probably here. 31 pips, 310 pips. Again, you wait till you get to either 121 or 161.8. So that's 3 to 1. That's more than 4 to 1 there. And so there you go. That goes all the way to the 1618. But again, if you want to be on the conservative side, you get off here at the 121, which is what I usually do. And by the time that happened, we've already formed another reference low. And so you're pulling from reference lows to the highs that drove the market structure break, right? And there we go. And again, we get a perfect entry, 61.8, halfway, like I taught you, halfway between 61.8 and 78.6. And again, there is your 121. So you come out there. That almost touches the 161.8, but by the time it fails and comes back there, you just come out anyway. And then that forms a new reference low in the process, right? And so you just keep moving your fib. So that's there. High to the low there. Again, see, 61.8, 78.6, perfect. And you just keep moving until you will get to one where the reversal happens. And when the reversal happens, you may take a loss, but then as you see, there's no significant move here. And even if you entered here thinking, well, that wasn't an engulfing, so that's no reaction. But even if you did, by the time it formed an engulfing the other way, you take a small loss and get out. And that's when we talk about the trend bending or ending. It's no longer your friend when it ends or it bends. So back to now, other than that, though, what's the real price action? This is the real price action. Fibonacci is just a tool, and I allow it because it has horizontal lines, right? It's not trend line based. It's not a funnel. It's a series of horizontal price lines. So it's one of the only indicators I will ever use. But you don't need a fib. Why? Just marry the market structure breaks with liquidity profiles. There's a break there, but does it come down to an order block? Where's the first manipulated retracement? That order block there. But remember, we're looking for intra-swing manipulation. So takes out that liquidity, then that order block comes into this one. Find support roughly halfway in the other block plus a spread. So that's the halfway point in the other block. 2 pips for the spread, 13. And then where are you going? First of all, back to the high. But then secondly, so back to the high, but also where else are you looking for a previous liquidity profile? So that's a previous high there. And what do you know? Price touches this to the pip. So you get out there. You wait for the retracement. You don't guess. You just wait for it. Where is it coming back down to? It's coming back down to the rough range of the previous market structure break where price stood around, but where exactly? Where exactly? Well, either an order block, that's one liquidity profile, but I've told you about the cascades. In addition to the other block, there is also an old high. Remember, old highs become new lows, and there's a reaction there perfectly. And so you take it again there. What's your 239 pips? Where you going? Where you trying to get off a previous liquidity profile? See that high there. So you get off there. Again, at that point, you come back and ask yourself, where was the last market structure break? It was there. When it goes beyond there, what's it going to? It's going again, look, at that point to a previous level. That was, this level started here. We respected it there. What do you know? Price respects it here again. Can you see? There is also, on the weekly chart, that would be on, that entire section would be an order block on the weekly chart. To show you that. There we go. See, that's one weekly order block right there. How do I know? Just experience. But you have your level. So all the Fibonacci is doing is showing you that the levels form at generic points based on previous price action. But you can go back in time and see the actual levels there. And of course, if you then add a fib to this, it's perfect because one, the fib is telling you that's a perfect entry point. There is a weekly order block there. It is lining up with a previous high and low there. That's now a reflection point. And there's a reaction. And so you apply, so you then apply all the principles we've taught and are teaching you, but you know you're in a trend. So every time price moves, you're telling yourself expansion, retracement, market structure break, liquidity level, wait for confirmation, go again, always in the direction of the original trend. And this, my friends, is how the markets move. This is how you apply. And of course, I showed you this in the 1 hour. If you were to drop down into a lower time frame, like a 4-hour, 15-minute, it becomes even more refined because now your market structure break levels can see. So there, that would be a market structure break. That would be price returning to the level. You could take this trade. Then you get out, sit through the manipulation. You come back down here. There's another market structure break there. And it goes. So you can refine. So in this case now, your stop losses are even smaller. So what was the 25 pip stop loss now becomes a 15 pip stop loss. You keep the same overall targets. Look at that. That's an 80 pip. That's 421. This is just in a 4-hour. And you can refine it down even further. But this, like we're showing you the other, but the same principles apply. You just understand the generic condition you're in and you start keying levels of that condition. Thank you guys for your time. I'm going to run off now. Take care. Have a great week trading. Bye-bye.